Has anyone noticed that we don't have enough homes for sale? This is actually the reality, even though it seems like inventory is not flying off the shelf. What I mean by that is homes are not selling as fast as we are expecting them to. You see, over 1% of the US population, actually it's about 4.5 million homes are needed to meet the demand out there. But the problem is the prices have not fallen down yet, and what have the builders started doing? They've started cutting back. This marks another month of a decline in the housing starts for new construction, not just single family homes, but also apartments for multifamily. So construction for new homes fell 5.5% in May, just last month. And this is the lowest we have been since June of 2020. And I don't know if you remember, but June of 2020 was one of the most uncertain times in the last 20 years that we have had when the pandemic hit. A lot of the builders had no idea. Are prices going to be dropping? Everyone thought it was going to be dropping. The stock market fell just a couple of months before then dramatically. And what they started doing is they stopped. They pulled back. They stopped. They said, hold on, we don't know what's going to happen. Let's pull back. But then, of course, the federal government lowered the rates. And once the rates were lower, then they started back up again and picked up on the building spree. And then it's all history from there. Things went up really fast. But right now, this is not the case at all. Right now, we are in a totally different scenario, and it's looking literally 30 times worse, okay? What we're looking at right now is about 1.28 million homes on an annual basis that are going to be built. And in April, just 1 month prior, we were expecting to have 1.35 million. But we still have a 4.5 million housing shortage. Listen, it's going to take many years to catch this up. And with all this immigration happening, people coming in from different countries, legally or not, that's a different scenario. But all these people are going to need housing. And right now it might be, some subsidized housing helping them out, but it's just a matter of time before they get on their feet and stay here and then get some immunity or something. And then they're going to need to buy a house. And where are those houses going to be? I don't know. They're not here yet, and the slowdown has begun. Let's talk about how this impacts you buyers out there and then you sellers. Really, think about this. If we don't have enough homes to meet the demand, which is kind of the case right now, then prices are going to stay up, even with this really elevated interest rate atmosphere that we have. We have high rates. Well, not really, but that's what everyone thinks we have. But it feels like we have high rates because they're about 7% right now. And people have kind of stopped and they're waiting on the sidelines before they make a decision. But if we have a drop in interest rates, then theoretically the demand goes up, right? If we go to 5%, the demand is going to go up, but where are the houses going to be? They're just going to be what we have right now and the 1.28 million that are going to get started and finished up this year, which if we didn't have any rate changes might be just maybe okay, but we're probably going to have some rate cuts depending on who goes and becomes president, and depending if we have a war, and depending, there's so many reasons why rates can go up or go down. And what's really impacting the builders from pulling more new housing starts, which is like the indicator, the leading indicator, before we actually get the permits pulled to start building houses, is the interest rates. The builders are saying not only is the cost of construction going up because of the interest rates, but also they're afraid of what the rates are going to be for the final sale. Because if the rates are going to go up, let's just say they go up 0.5 point every quarter for the next 3 years, then by the time these homes and these apartment buildings are finished, then the loan on the purchase is going to be cost prohibitive to a lot of people. And that's not a good thing for builders. So their decision on what they're doing right now is a little bit of a leading indicator of what we're expecting to happen. And that is higher for longer. Interest rates higher for longer. You've heard it before, and you're probably going to keep hearing it because I'm not seeing any light at the end of that tunnel. But that's okay, because with higher interest rates come better deals from the resellers. So if you're a buyer, this might actually affect you in a good way, only if the rates stay higher longer. But if they don't, then it's going to impact you in a really bad way. Double whammy. First whammy is that interest rates are going to be lower, so there's going to be a lot more people, a lot more competition coming out there. That's not good for you if you're a buyer. And second whammy is there's not going to be as many homes out there as there could be if we're expecting lower rates, because the builders have decided to slow down on the builds, so there's just going to be less homes out there. And I'm talking about, you know, a year from now pretty much, which we are in June 2024. So you have to take that into account. But also on the multifamily level, if you're currently renting, the apartments are also affected by this, because the new starts for apartment buildings has slowed down at a faster pace than the single families. So what that means for you, if you're a renter, is that there's going to be less inventory hitting the market, so the prices could stay up or could go up a little further if we have more people transitioning into the rental sphere, into the rental economy. And with the way things are going when it comes to the jobs market, there might be more renters out there. And with the way things are going right now with the jobs market, you know, the jobs report is looking pretty good, but the adjusted jobs report just from a few months back is looking absolutely horrible, because the jobs report is kind of a sham. What they're doing is they're reporting that we had a great jobs report, 216,000 new jobs. But then the adjusted jobs report is actually showing we had a negative 60,000 jobs. That's 250,000 jobs difference. What happened? Easy. What they're doing is they're basically creating these gig economy jobs. And these gig economy jobs are not full-time jobs. You need like 2 of those. So if you lose your job, your regular full-time, good, well-paid job, then you might go into the taking 2 or 3 gig economy jobs, you know, and be your own boss and feel like you're on top of the world, only find out you're working 92 hours a week and you're not making nearly enough just to survive. So those numbers showing 2 or 3 jobs added to the jobs report, 1 professional job lost, 2 or 3, you know, half-assed jobs added. So it's looking like, hey, we have job growth, but that's not the case. And once they've taken all of these things into account, what do we have? We have a net job loss, over 60,000 jobs. Not good for the economy, not good for housing, and not good for us, just regular people out there. And related to jobs is the next little report I'm gonna talk to you about, and that's the default rates for office buildings. This is once again not looking good. Now, I know that the general headlines out there are talking, oh, we are such a good economy, everything's feeling so good, all the stock market is going crazy, everyone's making money, jobs are looking great, CPI is looking great. You know, do you feel that? Please write a comment. Tell me, do you feel like you're doing great? And if yes, are you worth over $100 million? Because the answer is probably yes, because those people are doing just fine. But regular folks like you and me, you know, we're not doing so great. Lots of cutting back on the spending, but now the companies that own the office buildings, well, there's going to be possibly quite a few delinquencies and maybe even some foreclosures. Let's get into this. So what the reporting is that over $38 billion with a B, billion dollars of commercial real estate, especially office buildings, is in a position where they are at a very high risk of going into default or going into foreclosure or going into some other distressed type of sale. You want to know when's the last time we had such a situation with these kinds of numbers? 2012, 12 years ago. And you know what happened in 2012? Not much was happening. We were just in the very end of our major recession that we experienced. There was a lot of problems, a lot of blood on the streets, and you know, it was not a good time. I was there. I'm telling you, it was not happy. So we have to talk about what's going to happen. I mean, if people haven't yet gone through bankruptcy, haven't yet necessarily fallen behind, why is this being reported as such a bad thing? And once again, it just comes down to interest rates again, because the valuation of a commercial property very much has to do with how much money it can bring in and what the cap rate is of that area. Okay, well, it might be too much data for you, but what it comes down to is that you don't get a 30-year fixed rate, and they lend you based on the valuation. So if rent rates go down, then you can borrow less, and if rent rates go up, you can borrow more. But when the interest rate goes up, like it did, it doubled, because the majority of these loans that we're talking about, they got the loan at a time when interest rates were half of what they are right now. So when they're going to refinance after their 5, 7, 10-year mortgage, there's three main types of mortgages for commercial properties. They have to go and number crunch everything with today's interest rates, and unfortunately they're not going to be able to do it. Most mortgages for commercial properties are about 50% of the loan to value. And with the value going down, you're going to be able to borrow less. And then with interest rates going up, you're going to be able to borrow even less. So now what's going to happen? Well, it's quite simple. As early as 2021, we had about 90% of the commercial mortgages for office space be put into a security, and that security goes and gets sold to a hedge fund or a big investor like that. And when the loan comes due, they get paid off, and then they get their money back, then they can reinvest again. Well, they may not get their money back. So who's going to lose? I mean, obviously the smaller banks are going to lose too, because not every mortgage for commercial property gets securitized and put into a mortgage-backed security. A lot of them are held by the banks themselves, which is why we have 63 banks on the verge of bankruptcy, on the verge of going down forever, and people are going to lose money, which we need to talk about FDIC insurance too real quick, because that's a problem, but I'll get into that in just a second. So what really happens is that everybody loses with these high interest rates, because some people are not going to be able to get their property refinanced in order to pay off the loan that they currently have. Other people are going to give up their equity, they're going to sell, they're going to get out, and then there's going to be another subsection of people who just can't make either one of those happen. They're going to default, they're going to get foreclosed, they're going to get sued. There's going to be problems. It's not looking too pretty for office space at this moment, unless of course interest rates fall, and we might have interest rates fall if everything goes according to the plan that the Biden administration has set out. Great, we are going to have lower interest rates, but we're getting further and further away from the goal. We're not getting closer to it. Okay, we got closer. Okay, because we had 7% inflation, 8% inflation at a time. Right now we're in the mid 3s. So we need to get to 2 though, and that's a hard thing to do. So lastly, let's talk about FDIC insurance with these 63 banks. This is a huge problem. If you have cash, if you have money in a bank account, consider this. You may want to go buy some gold, okay? Because here's what's happening. Every bank account that's federally regulated, they get $250,000 per account that is secured by the FDIC, the Federal Deposit Insurance Company, and they're basically they have a whole bunch of money that they can go and pay back anyone who loses money out of a bank failure. Well, if these 63 smaller banks go under, the FDIC is going to run out of money. So what's going to happen then? So what if Wells Fargo falls? What if Bank of America falls? What if just one of the big dogs falls? Do you think there's going to be any money left over for you after FDIC spends all the money bailing out these smaller banks? It's not really a bailout. They're just paying the insurance. It's like an insurance claim more than anything. So no, they're not. But if everyone goes out and withdraws money to go buy gold or something, then we're having like a bank run or something. So they're not going to have the cash to do that. So that's going to cause a bank failure too. So really, what's the problem? Over leverage. That's really the problem. They have too much money out there, lent out to people, companies, whatever, commercial office space, and they don't have enough money deposited. And then there's not enough actual cash in circulation. That's another thing. So all of these numbers are getting worse and worse and worse. I'm not seeing the light at the end of the tunnel. Does that mean I'm going to go and sell my properties? No, I'm not. I'm going to keep renting, keep improving them, and just keep addressing what I can. That's what I think. What do you think?